Please note this breakdown is strictly for educational purposes and does not constitute investment advice. Constellation Software's first quarter results show a compounding machine operating at two distinct extremes. The mechanics driving this firm are straightforward. They generate cash and redeploy it into new software acquisitions that clear an exceptionally high internal return hurdle. In the first quarter of 2026, that deployment engine hit a record pace, putting $766 million gross to work on new acquisitions. That is 7 times the amount of capital they deployed in the same quarter last year. To measure this deployment success, we focus on the firm's preferred internal yardstick, free cash flow available to shareholders. This chart tracks cash per share. In the first quarter, free cash flow reached $34.54 per share, representing over 43. Favorable working capital timing inflated this, but the trailing 12-month level confirms the compounding trajectory. This record deployment volume indicates that the firm's primary compounding mechanics remain effective, even as the total pool of capital continues to expand. All of that newly deployed capital eventually filters up to the top line. Total revenue for the quarter increased by nearly 20%, reaching $3.18 billion. Looking at this breakdown of maintenance revenue, you see a steady upward stair-step progression. Maintenance and recurring revenue now make up 77% of the total mix and grew 22.4% over the past year. Because these contracts are deeply embedded in customer workflows, implied annual recurring revenue is a reliable benchmark to measure their recurring base. This chart plots that implied metric over time. In the first quarter, their annual recurring revenue officially crossed the $10 billion threshold. This mid-20s% expansion is driven entirely by their inorganic acquisition pipeline. While public software multiples contracted during recent market shifts, Constellation's private market acquisition engine avoided similar volatility, continuing to absorb high-quality revenue without pricing friction. But that record capital deployment masks a persistent operational friction. The primary constraint on Constellation's performance is its consolidated organic growth. Adjusted for foreign exchange, their organic growth sits at 2%. This chart deconstructs growth by segment. The teal line for maintenance hovers barely above the baseline, stepping down to 4%. The dark blue line for licenses is a significant drag, sitting at negative 13%, extending a secular decline spanning over 8 quarters. Relying entirely on buyouts while the existing portfolio stagnates creates operational drag for a company attempting to compound past $10 billion. That top-line stall is amplified by a secondary pressure point, declining operating profitability. In the first quarter, EBIT margin dropped 342 basis points to 13.7%. Part of this is seasonal payroll taxes on bonuses, but the larger drag is the record M&A volume. Constellation is currently digesting a cohort of new acquisitions, requiring immediate operational integration. This initial integration cost is a known feature of their business model, but the severity of this drag requires monitoring over the next 2 quarters to ensure it's temporary digestion, not structural margin decay. Because of these complex operational layers, the reported net income growth of 216% is a poor indicator of underlying health. That gain is a byproduct of specific accounting variables, a lower pre-recast baseline, a $76 million revaluation gain, and a $45 million FX tailwind. Stripping away those distortions proves exactly why free cash flow available to shareholders remains the most reliable signal of the firm's actual financial health. Management is aware of these operational friction points, and they outline their strategic response at the recent annual general meeting. President Mark Miller openly voiced his frustration with the lack of internal momentum, stating his intent to push the operating groups harder on organic growth. The lever he plans to pull to force that growth is the implementation of artificial intelligence as an operational tool. They are shifting their product architecture toward what they term systems of action. These products integrate predictive engines that autonomously execute tasks within a user's workflow, rather than serving as static databases. Crucially, Constellation is not issuing a centralized AI mandate from headquarters. They operate as a culture of cultures. Operating groups like Modaxo and Lumini host their own localized, regional AI accelerator events. At these events, developers and product managers build specialized solutions tailored to their precise customer niches. The immediate tactical goal is to upskill their engineers and use automated coding to compress product development cycles from years down to a matter of months. By deploying these rapid upgrades, the operating groups can justify new, higher pricing tiers, creating a mechanism to accelerate that 2% organic growth rate. Even if they solve the internal growth problem, Constellation still faces the mathematical friction of the law of large numbers. When generating nearly $2 billion in free cash flow a year, relying exclusively on acquiring tiny, privately held software companies becomes a bottleneck. To relieve that pressure, the firm is evolving its acquisition playbook through what they call the Permanent Engaged Minority Shareholder Strategy, or PEMS. Instead of buying entire private companies outright, the PEMS model involves acquiring minority equity stakes in larger, publicly traded targets to influence corporate governance and capital allocation. And while they test these new capital pathways, management confirmed at the AGM that they have not seen material customer churn from AI disruption in their existing portfolio. Because the core operations remain sticky, Constellation maintains a pristine balance sheet and continues to avoid share repurchases. Generated free cash flow is funneled back into their widening M&A pipeline and these new PEMS initiatives. Despite the structural drag of weak organic growth and the short-term margin compression from their acquisition cohort, Constellation's compounding machine is adapting to its own scale.